What's up, everyone? Welcome back to my stock market weekly update series. In this week's episode, tech giants are starting to announce mass layoffs. So we'll take a look at what this means and if it's signaling a coming recession. Plus, earnings season for the last quarter of 2022 is here, with popular stocks like Netflix, Procter & Gamble, and United Airlines all reporting this past week. So we'll just take a really quick look at that as well. And as always, we'll quickly run through the biggest gainers and losers for the week at the end of the video too. Timestamps are down below if you need them, but I hope you enjoyed the video. Let's dive straight into it. All right, and starting first here with the markets, this was actually the first week of the year that the S&P 500 came in red, but it was only by a small amount of less than a 1% drop. Year to date, the index is still positive by over 3% and is just slightly out of bear market territory for now, down about 18% from the top, although I wouldn't be surprised if it falls right back into a bear market again soon, considering how bad the economy is looking, which we will talk more about in just a second. The tech-heavy Nasdaq is a better representation of that, as it did actually end the week positive by about half a point and is having a strong start to the year so far at positive 6%. However, from the top, it is still down a massive more than 30% crash, and it could easily get worse from here. Which brings us over to the market news for the week, and right now all eyes are on the massive layoffs that have started to hit really hard. See, back in November, Amazon had announced that it was laying off 10,000 workers, but as the economy continues to get worse, Amazon has now announced an additional round of layoffs this past week, increasing their total count to more than 18,000 people being let go from their jobs. And tons of other tech giants are joining along, with Microsoft also announcing another 10,000 layoffs this past week too, saying that the next 2 years will be a challenging macro environment for tech companies, and so they will need to start running more efficiently. To give you a sense of how large these job cuts are, this was the second largest reduction in Microsoft's history, almost doubling what they did during the Great Recession, and only surpassed by the 18,000 job cuts in 2014 when the new CEO took over and cut over 12,000 Nokia employees from a partial acquisition. So in many ways, this could actually be seen as the largest pure job cuts in Microsoft's history. It is very significant, guys, but it doesn't stop there. Facebook and Instagram parent company Meta also announced over 11,000 layoffs, which is a double-digit percent of their workforce. It's about 13% of their entire workforce that they just let go. Google is also cutting 12,000 jobs. E-commerce platform Shopify is cutting 10% of its workforce too. Online furniture retailer Wayfair is also cutting close to 2,000 jobs. Cloud-based marketer Salesforce is cutting 10% of its staff as well. Twitter has already cut about half of its entire workforce after a reportedly massive drop in revenue. And just in the past year alone, the biggest tech companies have already laid off a staggering more than 70,000 workers, which is of course raising recession fears even further, whether we're already in one or there's a recession right around the corner. Either way, the point is that the economy is probably struggling to grow right now, and really anyone that is saying that everything is completely fine, there's nothing to worry about, and the economy is doing great, I mean, do you really think that this many companies would be laying off so many people if everything was just perfect out there? Clearly it's not. And I would say at the very least, the economy is growing at a very small rate, which is of course not good for business and not good for the stock market. And I still think that the risk of a recession is pretty high at the moment. Now, having said all of that, I don't necessarily think that it's reason enough to panic. I think that, as sad and unfortunate as these layoffs are, I would say that a lot of them are actually justified, because most of these tech giants, most of these tech companies, not even giants, but just tech companies in general, during the pandemic, they saw unprecedented growth because everyone was staying home and relying on internet technologies. And so these companies went out and they hired a ton of people, thinking that this growth would last forever, and maybe this would be their version of the new normal, where everyone just keeps relying so heavily on internet usage, and that keeps growing and growing at the same rate that it did during the pandemic, which is clearly not going to happen, because coming off of the pandemic now, we're seeing that growth slow way down. And of course, with the economy as bad as it is, with high inflation, high interest rates, these companies are not seeing that same type of growth that they did before, and thus all of those new hires that they made are no longer justified, and they need to cut that down again in order to balance out their business and reduce their costs as much as possible in this macro environment. And on top of that, a lot of these companies are really just having company specific issues that don't even have to really do with the economy. Like, for example, Microsoft is laying off a ton of workers from their HoloLens division and their Edge internet browser. And I don't know about you guys, tell me, how many of you do you think have a HoloLens headset or are using Edge as your primary web browser? I would guess very few, if any at all. So letting people go from those divisions, I mean, again, as sad and unfortunate as it is, it makes sense because those products are probably not selling as well as they had hoped, so they need to cut down costs. You also have companies like Meta, for example, who's transitioning over to the metaverse, and that's a market that is not yet matured. So they're taking in heavy losses, billions of dollars every quarter, and so they need to cut costs as much as possible, again, especially in this macro environment that we're in right now, this challenging macro environment. And so unfortunately they do have to lay people off in order to balance out their budgets. But again, I'm still of the belief that even if we do have a recession this year, I actually think that it's going to be a relatively short-lived one. I don't think it's going to be a very long-lasting recession because supply chains are being restored. We have such high interest rates right now that are climbing at such a high rate that if we were to go into a recession, we will have that ammunition of bringing down interest rates, especially if inflation comes down because we're restoring supply chains. So you have restoring supply chains, you have inflation that is coming down slowly and that could ramp up here shortly. And then you're also going to have high interest rates that you could cut down. So that would help the economy bounce back, I think, a lot faster than people might expect. And that would be good for the stock market. So here in the short to medium term, I think the stock market will continue to do pretty bad. And at the very least, it'll be very volatile. And of course, if we have a recession, it'll probably fall much further. But I think, again, it'll be short-lived, or at least shorter-lived than most people expect. And I think coming off of that, I think it will rally and I think things will recover. That's just my optimistic viewpoint. I know I tend to be overly optimistic, but look, in a world where everyone is so pessimistic all the time, if I can be at least a little bit of that optimistic kind of a figure for you guys, I'm willing to do that. But those are my honest beliefs, and that's my opinion on everything that's going on. With all of that said, though, earnings season is, of course, underway right now, and we had some pretty big stocks here report this week. So let's quickly run through those, and then we'll just finish up with the biggest gainers and losers for the week. All right, now we had a few big companies report this week, including Netflix, United Airlines, and Procter & Gamble. Now, the streaming giants Netflix destroyed subscriber expectations, posting 7.7 million new paid subscribers in the fourth quarter, beating expectations by a monstrous more than 3 million subs, which was likely boosted by their new ad-supported tier that they just recently launched back in November. Now, as far as pricing goes, Netflix now offers the cheapest tier at about $7 a month with commercials, while the other plans charge either $10, $15, or even $20 a month. And this is obviously helping them compete more with other streaming giants that have various price points as well. Now, despite the strong subscriber numbers, though, revenue still came in flat versus expectations, while earnings per share missed by a huge amount here. I mean, it's, what is it, 12 cents versus 45 expected? That's a pretty big miss. Now, still, the report was strong enough to lift the stock up by over 8% for the day. However, it is still down by almost half of its entire value from the top. As I've said before, though, I think Disney and even Amazon are much better plays on the future of video streaming, while also being, of course, much larger, more profitable, and of course, more diversified companies as well to own in your portfolio. We also received a report from one of the biggest airlines this week in United, and right now these airliners are actually benefiting heavily from a return to travel coming off of the pandemic, as well as inflation raising their ticket prices, which helped United beat on both the top and bottom line. In fact, things are looking so good right now for airliners that they expect, United especially here, expects sales to soar by 50% next quarter year over year, with a 20% increase in flights. Next week, American Airlines is scheduled to report, and they already raised their guidance from 11% up to 17% as an increase to pre-pandemic sales. So in other words, airliners are coming out of the pandemic even stronger than before it. So it may actually be a good time to start looking deeper into these airline stocks once again. I just personally wish that they still pay dividends because these used to be some of the best dividend payers in the market up until the pandemic really destroyed them. But as it stands, United stock has now surged by over 30% this year, although it is still down about half its value from the top. I don't personally own any airliners at the moment. And finally, Procter & Gamble also beat on both the top and bottom line thanks to inflation raising the price of their consumer staple products like Tide, Downy, Crest, Gain, Pampers, Gillette, Bounty, and lots more. I mean, the list goes on. They own so many brands. But anyway, the stock has never really interested me personally all that much as it's very slow moving and it rarely ever dips, which is not necessarily a bad thing, but it just means that it can be a little difficult to get really big gains from it because you don't get a whole lot of buying opportunities. And even though I love the dividend growth history of over 6 decades, the yield is a little low at just 2.5%, and the revenue growth usually climbs. I think like the next few years it's supposed to climb by only around like 2% per year. So it's just a little too boring, too low growth for me personally. Make sure you guys catch next week's episode though, because we'll have some huge earning reports to review from some very popular stocks, including Microsoft, Tesla, and a lot more, so you won't want to miss that. Finishing up here though with the biggest gainers and losers for the week. Nothing too crazy happened this week, but overall we did see a lot of tech stocks put up some pretty good gains, with National Instruments seeing the biggest climb of 35%, which is a software provider for engineers and scientists, but they actually climbed because of other companies bidding to acquire them. I think Emerson Electric is the top bidder right now. But we also saw some money-related stocks climb, with banks Ally Financial and SVB both climbing around 15%, while the cryptocurrency giant Coinbase also rose about 16% for the week, bouncing back from the heavy damage that they took during the FTX scandal and collapse. As far as banks and crypto go though, I only own Chase stock as a pure bank, and then a couple of fintechs and a few individual crypto coins, but in very tiny amounts. The online shopping platform Shopify also rose by double-digit percent for the week, which I actually just made a video on recently. It's called Stocks My Viewers Want Me to Look At. So if you want to learn more about that stock, I would recommend that video. But then scrolling down the list a little bit, we also saw a bunch of stocks here that I actually own myself that climbed this week, which I was pretty happy to see. We had Nvidia, Google, and Tesla. I own all three of those, and they all climbed by around 8% off the rally in tech stocks. And then the cybersecurity stock Palo Alto Networks also rose about 7%, which is a spec stock that I do enjoy tracking, but I don't actually own it yet myself. And then just a little further down the list, a couple more stocks that I do own also rose by over 5% in the Chinese e-commerce giant Alibaba, as well as the speculative fintech in SoFi. Currently, I am up over 80% on my Alibaba position, which I'm very happy about because my videos on Chinese stocks, they were the ones that usually received like some of the most negative comments for me, saying that I was that I shouldn't be buying them. But so far, it looks like my bet is paying off, so I am happy to see that, thankfully. Anyway, so moving on here to the biggest losers for the week, we had a couple of European legacy tech stocks in Ericsson and Nokia falling around 8 to 10% each, with Emerson also falling over 10%, who we just talked about. They were trying to acquire National Instruments, so shareholders may not like all the uncertainty around that. But by the way, Emerson is a pretty interesting stock too, with a good engineering and electronics focused business. I do like their business, but right now I feel that the price is a little high, which is keeping the dividend yield a little low at just around 2%. But if it ever dips hard, that would be a great dividend king to pick up because they have over 6 decades of consecutive growth on that dividend. So Emerson is a pretty interesting stock. Scrolling down the list though, we also saw a bunch of automotive stocks fall, with GM and Ford falling about 8% each, while speculative EV stocks like Rivian, XPeng, and even NIO all falling by over 6% as well. I actually just recently started buying NIO stock, so I may be interested in adding some more shares on the dip, but I'm also curious about GM stock too, since I like how much they're investing in electrification and autonomous driving. So being down almost half its entire value right now is starting to look pretty interesting. I may have to make a video on them soon. Let me know if you'd want to see that. I don't own the stock yet, but I'm definitely looking deeper into it. And then we also had a couple more financial stocks dropping in Charles Schwab and Goldman Sachs, who both reported bad earnings at a time when most other banks have actually been reporting positive results. And Goldman is even being investigated by the Federal Reserve over not having proper safeguards, in its consumer business, which they also pointed to in their earnings as one of the reasons for the bad quarter. And finally, here, I'll just mention really quick that 3M also fell about 7%, which is a stock that I own myself. And they've been dealing with giant lawsuits over the past few years, so I haven't been making any changes to my position, but I'm just kind of holding a very small amount of it at the moment. As a whole, though, 3M stock is now down over half its value, leaving one of the absolute most attractive dividends in the market with about a 5% yield and over 6 decades of growth. So, man, if those lawsuits get resolved, this stock would be, I think, a tremendous value right now. I think it would be a screaming buy. Anyway, that's going to do it for this week's episode. I hope you enjoyed it. Let me know down below in the comment section everything you think about anything I talked about in the video. I would love to hear your thoughts. And don't forget to tune in for next week's episode because we will have more earnings to discuss there as well. Some of my biggest stocks will be reporting, including Microsoft, Tesla, and others. So it's going to be a lot of fun, but I hope you're all doing well. I hope you all have a fantastic upcoming week, and I will catch you guys in the next video. Take care, my friends. Bye-bye.